Hello there and welcome to the Hashpower Academy. The topic of today's video is the biggest risks to Bitcoin, not just the asset but the underlying network of technologies and commodities that are all intrinsically and mathematically linked together, from energy all the way to finance through computation. Now, there is several risks to all different parts of this network in a sense, and let me just start with this. If you were to try and kill Bitcoin, so to speak, to completely dismantle it entirely, you would have to switch off every form of power production on this planet, on and off every grid. You would have to disconnect every single grid, every electrical grid, and switch it off. You would have to destroy any form of computation, any computer that could add Bitcoin blocks to the chain. You'd have to completely dismantle and disconnect the entire internet and stop any form of device communicating with another. You'd have to destroy every single node, every SSD and every storage device for containing all of the Bitcoin transactions. You'd have to destroy any form of system, service, product, market that is trying to allow people to communicate all of that digital money value between each other. In a sense, you would have to completely dismantle all of human civilizational infrastructure. So I don't think it's going to happen. But the topic of today's video does also delve into the biggest risks in the context of the different businesses associated to these different areas, namely the centralization of compute power in the mining pools, the decentralization of central banking, the issuance power of money. Well, Bitcoin decentralizes the issuance power of Bitcoin through who issues the blocks. And who issues the blocks? Directly, it's the mining pools, but they are a group of underlying Bitcoin miners that are computing all into a pool, and the pool manages the issuance, the block templates, which is all the different transactions that they are choosing to put in their block. If the Bitcoin network was an Excel spreadsheet, and you can think of every line item being the ownership of the units in each line, being the Bitcoin wallets and their holders. The nodes are everyone that has a copy of that Excel spreadsheet, and the miners are essentially the ones that have write access. They have permission to actually edit the sheet, but they can only edit the sheet with the permission of the other two to add the information and update whose information is moving to whose wallet. So that's an overall gist. Other sorts of businesses are, well, the production side of things from Bitcoin mining hardware is from a handful of producers, Bitmain and WhatsMiner, but namely Bitmain. They have a significant market share of producing the computers. That is an aspect of centralization that could be considered risk. On the energy side of things, not so much. That's very decentralized. Bitcoin is on and off every electrical grid on the planet. It can be as small as a single little solar panel and a Bitax mini miner. It could be as big as an entire city. And I do have design ideas for a Bitcoin city that we'll discuss in another video. And all the way up to the financial side of things, the Bitcoin in particular wallet, whether it's in an ETF and with a custodian essentially underneath, that there are several ETFs which are IOUs of redeeming underlying Bitcoin, and they've all got their Bitcoin stored with a particular custodian. That is a centralization risk in terms of the monetary units, the owners of the data on the so-called Excel spreadsheet. And on the communication side of things, we discussed the Bitcoin mining pools and their issuance power, but that communication between pools and where the Bitcoin is located, there's other entities such as platforms, exchanges. There are still quite a lot of people that have Bitcoin in different sorts of platforms and exchanges, and that is a risk to, well, someone else is custodying your Bitcoin for you. Now, here's the thing. The majority of people are not going to self-custody. There is systematic inevitabilities of sort of the human side of this, where some people just will prefer that other people look after their Bitcoin for them. Whether it's because you have a grandparent or a parent that's just not interested to manage the security of their own money on their physical persons, or within their home, or on the extreme end of security, which is to have a multi-signature setup. So think of it like some Indiana Jones thing where they have to plug in two keys and turn them at the same time to access the gold totem behind the rock. Those sorts of things. And on that extreme end, if you create a security environment to protect your Bitcoin to the extreme, there are some people that have made all these crazy layers of security protection for their Bitcoin, and something went wrong and now they've lost it. Or here in the UK, actually, someone, or the amount of people that they had Bitcoin in a wallet or in a hard drive, forgot about it years later, and now there's a hard drive here in the UK in a landfill that's worth millions or billions of dollars worth of Bitcoin on it. So time affords value to Bitcoin, that's the thing. One of the positives actually of when Bitcoin is stolen is this is a danger for people that think that they can steal Bitcoin. It's going to go up forever in terms of its value. So the incentive to hunt that person down and recover that Bitcoin goes up forever. So it's not worth trying to steal Bitcoin because the incentive for people to come and find you only goes up over time. So your risk, your benefits versus your risks, it's not working for you, it's working against you. And there's several different other pieces to this, but there's a lot of focus, say, on the financial side of this. These large entities, companies, BlackRock's as one example, all the other different financial firms trying to wrap their head around different products, markets, and services that they are going to offer people to accumulate as much Bitcoin. If you boil it down to the under the hood observation, they're going to want to accumulate as much Bitcoin as they can under their custody and offer all different lending, loaning of financial services and Bitcoin bonds on the government side of things. To the technical level, they're going to hold Bitcoin on your behalf and give you some form of incentives or benefits and trade-off as to why it's worth it. In terms of the compute side of things, there's a danger with the cryptography aspect of things, with quantum. If there's an issue with all of the Bitcoin that's in wallets having a certain amount of data cost and moving all of that Bitcoin into new quantum resistant wallets, when there's only a constrained amount of limit of the amount of data that can move through the blockchain per day at any moment in time, and the volume of data that would have to move through the blockchain is years, multiple years worth of transaction demand. That could collapse that could collapse price in the sense that if block rewards in terms of fees were to skyrocket, the production cost of Bitcoin for the miners absolutely collapses. And then the danger side of the Bitcoin being that if it's hard to move because the fee market's really expensive and the fees are massively rewarding miners, it's this duopoly that there would be lots more mining plugging in, which would accelerate the rate of blocks being mined. So the Bitcoin network by design has all of these mechanisms that the more you attack it in any way, the more it defends itself. For example, the China ban is the opposite way around. When China banned Bitcoin mining, half the network literally switched off. And what happened is the other half of the network started earning essentially twice as much Bitcoin. So that incentive to, half the network was attacked, so to speak, and the other half got paid twice as much now. Price did react, and if you remember from the 2021 bull market, the price went up and had this big dip and then recovered just above the all-time high that it had set before, and then it went back down and back to the production floor where Sam Bankman-Fried tried to suppress the Bitcoin price below 20K, not knowing that he was contending with the production floor, and Bitcoin miners don't just buy energy, sell Bitcoin that they've produced, they can also sell energy and buy Bitcoin if the price goes below production, which we've discussed in a couple of other videos here on the Academy. There is going to be several other things, such as the AI side of things, that if Bitcoin is afforded to people but based on their energy and compute efficiency, that also extends to the sort of codified logic. And if AIs are highly efficient and highly productive and they have a direct understanding of what Bitcoin is, a natively digital form of currency that is self-sovereign to it, well, AIs, if there is some form of scale of intelligence to these language models, which they currently just are, if there is a scale of intelligence to them and they conceptualize that Bitcoin has a value to hold, we could see a shift as to how much Bitcoin is owned by AI agents and bots, and someone's going to code an AI that says, try and accumulate as much Bitcoin as you physically can, mentally can, emotionally can, all these sorts of things. Trick humans in every way. Not everything's fair game at this point, and the overall approach is we want to create incentives that build prosperity, continually building out the energy sector, continually making better chips, and that just builds a more abundant world for everyone. And all of that expansion of these massive sectors, hash rate going up, raising the difficulty adjustment, which raises the requirement to crack the next block in the chain, because miners are paid to not attack the network. Let's get this straight. The one thing that controls issuance power of this form of money is producing blocks. And producing blocks, you've got all this proof of work side of things. So we just mentioned the AI risk, or even the quantum aspect of things, continually raising that cost to brute force crack the next block in the chain. And it's the only thing that can update the chain. And yeah, there's several different risks, but the dangers to price specifically, that's more of the leaving the traditional credit money world side of things, and the different financial products, markets and services, and Wall Street playing their Wall Street games, so to speak, of holding Bitcoin in one place and shorting it in another, and constantly just stop loss hunting the entire market until they've accumulated enough Bitcoin, and then just let it naturally grow. And the reason it does that is because the amount of Bitcoin being sold is so minimal. The amount of freshly issued Bitcoin from the mining sector is barely 450 Bitcoin per day, and multiples of 450 Bitcoin is purchased per day. So when the price, say, is suppressed, there's probably something to do with the futures market playing games there. I think that's enough for today. I hope you enjoyed this video. I hope this was quite a broad perspective of different risks to Bitcoin. There is several others in all different areas, especially some people are concerned at the amount of subsidy per block constantly cutting in half, but that does actually raise the value of Bitcoin, because if a miner exchanges quantity of electricity into Bitcoin, that creates a pricing system. And if he's getting paid less Bitcoin for the same electricity, flip it the other way around. That means your Bitcoin, the halving, essentially doubles the electron value of your Bitcoin. And that's another topic that we'll go into more detail in other videos. That's enough for today. I hope you enjoyed. Like, subscribe, send it to the group chat, send it to the person that you know that loves Bitcoin the most, hates Bitcoin the most, and I will see you in the next one. Goodbye.